The entire purpose of the investment is to achieve your financial goals. And asset allocation plays a very key role in delivering the desired results. Let's just look at how the asset allocation works, right? So here I have taken the three asset classes. One is the equity, debt, and then the hybrid funds. So hybrid is nothing but the combination of both equity and debt. So for equity, the minimum investment horizon has to be always 5 years, and historic return has been around 11%. The debt, if you look at the fixed deposit rates, it's around 7%. So all the debt funds also they deliver around 7%. And for the hybrid funds, like I mentioned, it's a combination of equity and debt. In this case, I have taken that 70% would be in debt and 30% would be in equity. So typically, this is something which a conservative hybrid funds will be having, the combination. So in this, this is the portfolio which has invested in the Sensex and this one in the small cap. So they have not looked at the any asset allocation, and irrespective of their goals, they have invested. So somebody had a goal in the month of January 1995, and he has invested in the Sensex, and after 1 year, that person had a negative return of 19.454%. Similarly, for every year, I have calculated it like different horizons. Say in this case, somebody had a goal in the year 1986 on January 18th. So that person has invested in the Sensex. The return was around 17.45%. Right. Similarly, for 2001, 2008, 2009, 2020, these are the major drawdown periods. If you look at it, probably this looks as a very high figure. But if you look at the 2001, if somebody has invested in 1991, 25th September, and waited for 10 years, that would have been like 3.89%. So same thing in 2010 March, that would have been 4% return. So what will be the return in case of asset allocation? So as I mentioned, anything less than 3 years, it has to be in the debt funds only. So somebody in 2017 March, if he or she is an 2019 March, if they had some goal and they have invested in the debt fund, the return would have been 7% against a negative return of 31% at the Sensex level. So similarly, all these three are there. So for 3 years, it would have been a hybrid one. So that would have been 8.2. That is on 2017 March. So now let's look at the 10 years or 10 years return for this one. Let's say 2008, global financial crisis. So somebody had a goal in the year 1998 and they have invested in the October of that month. So just 3 years before this, that is like in 2005, had they removed their money and kept it in a conservative hybrid fund, so their entire return, annualized return would have been around 13%. They would have happily met their goals, right? In case of 7 years, that is like in 2001, right? If somebody has invested, let's look at this one now in 2001. So that would have been in 1994. If somebody has in invested in the equity markets for the 5 years and then they have taken out the money just 2 years before it and put it in the debt funds, the return would have been around 3% against the return of negative 7%. Right? If you look at the median returns, there is a huge amount of alpha which is there. On a 10 years time, it is like a 4 point, close to 5% of alpha. So, and these are 30 instances, right? Six different time horizons and five major drawdowns. In these 30 instances, somebody with who had 100% equity allocation, irrespective of their time horizons, has outperformed the asset allocation, outperformed the portfolio with an asset allocation only 2 times. Right? That shows how important asset allocation is, especially during the drawdowns. So more than 90% of the times, it is the asset allocation which is helping you with the returns, basically preserving the returns more than helping you with the returns. Now let's look at the various other asset classes which would be necessary for this specific asset allocation. Let's begin with the yield curve. So this is the fixed deposit rates of SBI, and these are the time horizons. So I've just plotted this, the time horizon with the interest rates here. This is called a yield curve. So which you typically hear in the newspapers, right? So basically, depending on your time horizons, you have to invest. So when you look at it, so if you are somebody who thinks that after a certain period of time the interest rates decline, you may want to lock in the interest rates at the highest, right? So, but what happens during an economic downturn is this yield curve inverses. The inversion is because the central banks usually decrease the interest rates so that it will increase the demand in the economy, right? So if you think the economy will not do well, it's always prudent to go for the longer time horizons essentially. So now, uh, just like now, let's even before going to the debt funds, let's understand how the bond pricing works. So just like the stock market, there is a bond market, and companies raise money at an interest rate for different horizons. Unlike a fixed deposit, a customer cannot liquidate it with a penal interest in the bank. Say, for example, you have got a fixed deposit for 1 year. So, if you want to liquidate it after 6 months, what a bank does is it applies the interest rate for the 6 months, and then they will apply a penal rate, interest rate, whatever is applicable for the time horizon, right? So, but in a bond market, what happens is you have to buy or sell a bond. So now let's just look at the how the pricing of this bond works. Say, for example, there are many companies which are there, so which raise funds for 5 years, 10 years, or 20 years horizons. So how do they price these bonds? And when you are selling it and buying it, how does this happen? So if you are buying it during the issue time, it is very simple. It's just like a fixed deposit if you are holding till the maturity. But what happens if you have to let go it in between of this maturity period? Say maybe you are having in mind that you will hold it for 10 years, but something has come up and you have to sell this, right? So it is a sim it is this simple formula which will help you in the bond pricing. That is nothing but the compound interest formula which you would have learned in school. So this says that future value is equal to present value into 1 plus r power n. So here Fe is the future value, PV is the present value, n is the time period, r is the rate of interest. So 1 plus r power n is called discounting factor or a compounding factor. So when we are calculating the future value, it is called as a compounding factor. When we are calculating the present value, it is called as a discounting factor, right? Let's say you have invested 1 crore per 1 year time horizon in the bond market. There is a recent issue and they are saying that the interest rate is 10%, right? So now the discounting factor 1 plus r by r power n. So that discounting compounding factor would be 1.1 in this case. So the future value would be 1 crore 10 lakhs. In the similar fashion, so if somebody needs a 1 crore 10 lakhs of future value, what is the amount he or she has to invest? That would be 1 crore here, right? Because the interest rate is 10%. Right now, let's say the interest rate, what is the let's say the future value has to be 1 crore 10 lakhs and the interest rate is at 9%. What is the present value of that corpus? That would be 1 crore 91,743. Now let's just take the example of an investor who has invested 1 crore in the morning at a 10% interest rate and its future value is 1 crore 10 lakhs. Now something has happened in the market and the company has decided that it will stop issuing the 10% interest rate bonds and rather it will start issuing 9% interest bonds in the from the afternoon onwards. So what happened was the person who bought in the morning, he did not foresee an emergency and he decides to sell it, right? So when he goes to the bond market, so he will be surprised to see that the same bond is quoting at 1 crore 91,743. The reason is in order to get that value, right? In the bond, they will clearly mention what is the maturity value. The maturity value in this case would be 1 crore 10 lakhs, right? So since the maturity is value is 1 crore 10 lakhs, so investor on the other side will be willing to buy this bond at 1 crore 91,743. The investor in this case would have made 91,000. So, but what if the company decides to increase the interest rates? So, in this case, the investor who bought the bond in the morning will end up selling it at 99 lakhs 9,910. So that means basically when an interest rate increases, the bond price decreases. When the interest rates decline, the bond price increases, right? So this is what a debt fund manager actually does. So they try to look at these interest rates and depending on the horizons, they take call on what would be the interest rate scenario in the future and accordingly buy or sell them. So what are the advantages if you are investing in a debt fund compared to the fixed deposit? One is the diversification. So when you are investing in a fixed deposit, you are only going to one single bank and the money is with that bank only. So in case of this, the fund, you'll be having like anywhere between 50 to 200 instruments, right? And these funds are typically investing in companies better than the investment grade. So most likely they'll be having the government bonds, TREPS will be there, state government bonds would be there, and highly rated companies will be there, right? They usually don't take a risk of investing in the companies which are just over the investment grade or below the investment grade. That is something which the credit risk funds do, which I don't recommend, because if you want to take that risk, probably you should go with the equity rather than trying to generate higher returns in the debt market, right? And the second thing is like there is no TDS. So on a fixed deposit, on a half yearly basis, the bank has to deduct the TDS until and unless you are saying that you are not falling under the tax bracket, and if you are giving that 15G or 15H, they will be deducting it, right? And even somebody with a higher somebody in the higher income tax bracket, so they will have to pay the tax at the end of the year in the tax filing season. But on the debt fund side, what happens is, let's say your horizon is over 5 years, 3 years, whatever it is, only when you liquidate the funds, whatever gains you realize, that will be clubbed to your income at that point of time, and you will be incurring the taxes. The good thing about this is you are deferring the taxes here. So that's the second advantage, right? And then we have what are called the arbitrage funds. The difference is the arbitrage funds will be taxed at the equity level. That is, you'll be having in short-term and long-term capital gains. So, but the returns they'll be delivering would be something like a debt funds only or a fixed deposit. So, somebody who are in the lower tax brackets or a zero tax bracket, that is below 12 lakhs of income, it makes more sense going for the debt funds because arbitrage funds may deliver negative returns in less than 3 months' time, and the probability of generating negative returns after year one are like really very low. So but over a 1 year period, they have, even over 6 months period, they have delivered something like a 7% annualized return, something similar to the debt funds. So if you are having some goals less than 3 years and maybe for the contingency, but if you can invest at least for more than 3 months, arbitrage funds make sense if you are in the higher tax bracket. So what exactly are the arbitrage funds, and what are the strategies the fund managers follow, right? So in arbitrage funds, there are basically three types of instruments. One is the equity, and the second is the equity derivatives and the debt funds. So usually, so in order to get any equity taxation, at least 65% of the funds have to be invested in the equity markets or the equity derivatives. So at any given point of time, the debt will not be more than 35% in the arbitrage funds, right? So they typically follow either the cash futures arbitrages and the dividend arbitrage. So there are two types of markets. One is the cash market, where you give the cash and take the delivery of the good or something, like just like the stock market. You are paying 1,000 rupees and you are getting that stock. And then there is a derivatives market where there is no physical delivery. So you have the options futures where you are paying the premium. The difference, whichever is there, that difference is usually paid by the um, party A and party B, like depending on who is gaining and who is in the loss, right? So here the first one is the cash future strategy. So now just think of it this way. So there is one stock which is trading at 1,000 rupees today. The fund manager bought it and he has an option underwriting team. So after underwriting, they have decided after a 1 month's time, they are willing to sell this stock at 1020, and the premium for that is like would be 5. Option is nothing but the right to buy or a sell. That means I am saying I am paying the fund manager this 5 rupees so that I can buy this stock after 1 month at 1020, right? So it doesn't create an obligation on me, right? An obligation on me to buy or sell. If it is trading more than 1020, I'll just simply buy it. If it is trading below 1020, I will just forego my option premium. But that's not the case on the fund manager. If I exercise my option, the fund manager has to deliver it to me. In this case, it will not be the physical delivery of the stock that will happen. The price differential is something he or she has to pay. Let's say after 1 month, uh, after 1 month, the spot price is at 1050. Now I will just have to give him. I have to sell this. I will be selling this stock at 1050, and I will just be paying him that additional 30 rupees to him. So now I made a profit of 20 rupees on the 30, on that 1020, on that 1000 rupees. And then there is a premium of 5 rupees which I have made during the underwriting. That is my total profit is 25 rupees, right? This is scenario one. Let's say spot price after 1 month is 990 rupees, right? So now the person who has bought the option will not exercise it. That means I have to sell this after 1 month at a loss of -10. That means my profit is -5 here. So that's why these kind of transactions happen at like there will be multiple transactions that will be happening. That will be huge amounts of buying and selling will be happening. So this will result in some profits. So since usually they are very much mispriced, so it is not so blatant like I have given here. So that they will end up making some 7%, 8% kind of return here. So then the second is the dividend arbitrage. Let's say the spot price is 1000 and the underwriting team has got a contract at 1000 rupees. So and the option premium is 5. So in the meantime, the fund manager expected that there will be a dividend of 15 rupees here, right? The stock will declare. So once the dividend of 15 is declared, so after 1 month, the stock price is usually around 985. Ex-dividend usually they will reduce by the similar amount. So now the option premium, the person will not be exercising it. So I would have got that 15 rupees, whatever is there, I would have, you know, the if the person is not exercising and if I will be forced to sell it at a 15 rupees in the -15 at the market. So I made 15 rupees from the dividend and I sold it at a loss of 15 rupees. The profit I made is only 5, right? Now let's say if this is trading at 990 ex dividend, then my profit will be 10. So instead, if they are only giving 10 rupees as a dividend, so my profit will be 5, right? So that's how these arbitrage opportunities come. That's the reason why in the shorter duration, they may end up giving you negative returns. But on the longer horizon, 1 year horizon, so typically you get something like a fixed deposit only. So now the hybrid funds. So these are the combination of equity and debt funds. So in a conservative hybrid fund, what happens is the minimum debt allocation will be 75% and the maximum can be 100%. Again, along with the debt, sometimes few funds use REITs and InvITs as well. Uh, And on the equity side as well, most of the time you'll find stocks which are giving you higher dividend yields. So overall, the conservative hybrid funds, if you are assuming the debt return to be around 7% and equity at 11%, so the range of return would be around 7 to 8%. So, but since there is equity here, so the minimum time horizon has to be at least 3 years, right? And the taxation will be at the income level. Because in order to get the equity taxation, at least 65% of the funds have to be in the equity products. Now let's go to the balanced advantage fund. So here the minimum equity levels will be at 65% and the maximum can be 100%. So the debt is like 0 and 35. So as a result, the returns will be slightly higher compared to the conservative hybrid. So assuming the same similar returns in the equity and debt, so somewhere between you will end up somewhere between 9.6% and 11%. This is a lot more resilient and the goals have to be more than 3 years. So if it is like anywhere between 3 to 5 years, this should be good. because there is a good amount of equity involved, and less than 3 years, there is a high chance of equity delivering negative returns. So this has to be always over 3 years time, right? But if you are somebody who wants a return better than the fixed deposit and want to take a slightly higher risk, balanced advantage funds are the go-to ones. So usually they rarely go to 100% equity position. So the maximum is like they will maintain around 65-70%, right? And even in the 65-75%, sometimes they'll be taking the arbitrage positions as well. So, like I have shown you, right, 30 to 35% of arbitrage positions are possible. So, overall, if you look at it, 50%, 40 to 50% will be in the pure equity at any given time, and 50% will be like debt plus the arbitrage positions. So, which will give you that downside resilience. And then there is a dynamic asset allocation funds, or else you can call this aggressive hybrids as well. So, where the fund manager can go up to 100% equity or 100% debt. So the fluctuations will be slightly higher, but the returns also will be slightly higher on the longer durations compared to the balance advantage funds. So essentially, uh, beyond the equity, there are three other asset classes which may be useful for the asset allocation for the goals. And balance advantage and dynamic asset allocation, usually the taxation will be the taxation will be that of the equity one. So it will be the capital gains, right? So the asset classes in the discussion are neither a recommendation to buy nor sell. It is purely for the education purpose only. Thank you.